Hi, everybody. This is Josh at Azzad Asset Management. We're going to give folks a minute or two to jump on, and then we'll be starting. So just a minute or two. Thanks for arriving on time, those of you who did. We'll be back on shortly. All right, everyone, and hello. Thank you for joining us. Welcome to today's webinar on investing in the age of trade wars. Thank you for attending. Just a reminder that this webinar is being recorded. I'm Josh Brockwell, Investment Communications Director here at Azzad. We're grateful today to have with us SKBA Capital Management, manager of the Azzad Large Cap Value Portfolio, to offer their firm's perspective on today's trade wars, a hot topic in the news, also potential costs of those trade wars to the U.S. economy and the market overall, as well as potential benefits should things turn out well in the end. So we're going to kick things off today with an introduction to SKBA, one of 7 institutional firms that manage Azzad's portfolios that we offer to clients. Then we'll turn to an analysis of the current trade tensions between the United States and China. Finally, we'll wrap things up with a look at how the Azzad Large Cap Value portfolio is positioned in light of these current events. So, with that, your presenters for today are Evan Key and Matthew Segura of SKBA. And for more on SKBA and how Azzad works with them, I'll go ahead and turn it over to them. Gentlemen, are you there?
Yes, hi. Before we get into tariffs, let me introduce our firm. Our firm is long-term focused, and that colors how we analyze companies, how we pick securities, and of course, how we handicap and manage around events like the escalating trade war. On slide 4, you see for this strategy, it starts with maintaining an ethical investment portfolio. From there, our focus on dividend yields as a research tool and initial valuation metric allows us to both pick up on what matters from a data perspective and also provides the portfolio with income, which provides the portfolio with downside protection characteristics. On slide 5, it's dividends, not earnings, that provide a better signal of fundamentals over a longer period of time. Management will talk about earnings every quarter, but we like to instead watch what managements and boards do with their dividend, which isn't changed as frequently. Not only are dividends an important component of wealth building for investors, but it's a good signaling mechanism of earning power. Firms know that when dividends go down, bad things happen. So they take a cautious approach, meaning less inherent volatility in the dividend policy as compared to earnings. So when dividend yields do get very high, oftentimes this means the market is pessimistic. And these are the best times to lock in that high level of income for through cycle returns. As dividend policies are set with longer horizons in mind, we find this is a good horizon match with our philosophy. And with that, I'll hand it over to Matt for the tariff discussion.
Thank you. On slide 7, here we have an example of tariffs' potential effect on the economy. The most recent meaningful trade war began with the Smoot-Hawley Tariff Act of 1930. The timing of these tariffs couldn't have been worse. At this time, the economy was still growing, yet the agricultural sector had begun to experience declines. When Smoot and Hawley began discussions about raising tariffs to benefit domestic farmers, politicians from around the state wanted in. Now, by the time it was all said and done, tariffs on average had increased substantially. This, combined with the tax increases and the ending of the Roaring '20s bubble, had all contributed to the Great Depression. One point, however, is that when the U.S. imposed tariffs on its main trading partner, which at the time was Canada, they retaliated with tariffs of their own. From 1923 to 1929 to 1933, the value of world trade declined.
Okay, I think maybe Matthew's having some technical issues there on his end. Matthew, can you maybe unmute the phone or try dialing back in? Looks like we may have lost audio. And as he's doing that, I'll point out that Matthew was about to opine on the fact that from 1929 right up through 1933, the value of world trade declined from approximately $5.3 billion to $1.8 billion. So obviously, despite what's said by our commander-in-chief, trade wars are neither good nor easy. I think that's the point that he would be making there. We could move right along. Let me jump in while Matthew hops back on the line. Let's go ahead and take a look at what's different this time. So,
Gosh,
given the current,
I think we just got
there he is.
Again here. I apologize for that. I don't know what happened.
No problem.
I think
we're good.
I got on right where we were about to finish up here.
Yeah. So I took care of that slide. You want to hop on, move on to slide 8? What's different this time?
Great. Thank you. So given the current situation, world trade is much more important to the global economy now than it was in 1930. The value of global exports is thousands times more than it was and is a much higher share of global GDP, which means a potential halt in trading activity has severe potential consequences for the global economy. Slide 9, however, there are many offsetting factors to this. One of those being the Tax Cut and Job Act in the United States, which passed in late 2017. We believe this law substantially increased the incentive to work, invest, and save in the U.S. In and of itself, we think it would have increased GDP to well over 3% when it came into effect over the next several years. However, the president couldn't just leave good enough alone. By taking executive action to combat what he described as unfair behavior by our trading partners. Now, one contrasting thought to the current situation from the 1930s is that President Hoover raised taxes significantly right at the time he increased tariffs, such that the after-tax retained dividends decreased by over 50% at the time he began a trade war. Given this, we essentially view the current trade war as an offset to the benefits of the tax cut. However, the longer the trade war, the bigger the offset. Slide 10, here's a chart detailing the amounts in which both sides are threatening to hit each other with tariffs. As you can see, it's proportionate to the amount of trade each country has with one another. It seems as though the Trump administration looks at the difference and sees leverage. However, it also means that's a lot of product that will be that much more expensive for U.S. consumers. On slide 11, we detail the imposition of tariffs and, more importantly, the retaliation from each country, which are in red. Tariffs the U.S. imposes on our trading partners themselves have strong potential to raise costs domestically, depending on the demand elasticity of the products. Basically, if there's high enough demand for the products, and the price increases may be proportionate to the tariffs. The point of this chart is to show that for each tariff the administration doles out, retaliatory tariffs are imposed on the U.S. the effects of these tariffs will likely increase the cost to export or decrease foreign demand for our goods. For example, a producer that imports and exports, which are a lot of producers in the United States, may be faced with rising input costs and lower selling prices. This is also a reminder that we are at a trade war with more than just China. Slide 12. Here we show the effects the tariffs have had on the market so far. Now we know the market anticipates and prices in good or bad news in advance. Now, since the beginning of 2018, we can see that the two sectors the market anticipates being affected mostly are autos and energy. As a result of higher steel costs and explicit auto tariffs, contributed to a global auto production slowdown, which began in the third quarter of last year, but was anticipated in the market as early as January of 2018. Utilities as bond proxies have become safe haven asset and as such have outperformed amidst the volatility. Healthcare and services also fits in this category, but in our opinion is more deserving of this status than utilities. Software and services have been the best performing sector over this time period because of another unusual phenomenon, and that's interest rates. When rates reversed course and began to decline late last year, the valuations on these long assets like software increased. Generally speaking, investors tend to prefer companies where profits are longer dated, like fast-growing and high-spending software companies, than those with more current cash flow and low-rate environments. The inversion in the yield curve in the fourth quarter boosted favor in software and utilities. Now, energy is the second worst sector over this time period, and we believe it's partly due to the market pricing in an economic slowdown due to the trade war from the demand side. Supply side appears to favor more firm pricing, but the market's current take on energy is that prices are likely to fall. On slide 13, so what is the aim by both countries in this trade war? Well, the Trump administration claims to want a more fair trade system, but also says he simply likes tariffs. This latter idea is based on a protectionist policy that says by increasing the cost of imports, domestic products become relatively less expensive, and other nations may purchase more of our goods, thus lowering the trade imbalance. Yet what is hardly discussed is that there's a benefit to having a deficit. A trade deficit on the current account, which are your goods and services, means there's an equal surplus on the capital account, which is your financial. What it means is that when we buy other countries' goods, we pay them in dollars. China, for example, has three options of what to do with those dollars. They can convert them back into yuan, they can buy treasuries, or they can buy US goods. Now, China has not been willing to convert, as it tends to increase the value of the yuan to levels they've not been comfortable with, so they're left with two choices: buy goods or treasuries. They've chosen to do the latter, which means they're making it less expensive for companies in the US to do business abroad by keeping the cost of debt low. So trade imbalances are not necessarily bad when looked at from that perspective. Now, as for China, they're clearly retaliatory. If you look at where China's targeting its tariffs, they appear to be targeting to upset a key component of Trump's voter base, the farmer. Now, another reason the Trump administration has imposed tariffs is to force the Chinese government to open up its economy and stop the forced transfer of intellectual property. In our opinion, this may be a worthy battle. If China believes it has lost its leverage, then it may open up its economy to the US, which would be more profitable for US multinational companies that can now compete on more of a level playing field. Slide 14, just a detail here in the near term. In our opinion, the effects can be acute as businesses halt their spending and wait for clarification on what the playing field will look like. Consumers also lower spending on big ticket items such as autos, which have an outsized effect on GDP. Lower spending in the near term can lead to a recession if it lasts long enough. And in terms of inflation, companies have already purchased goods ahead of the tariffs, which increase inventories and will likely suppress the incidence of inflation in the near term. On this, we do expect it to reverse if it should last much longer. In the medium term, a lot of the price inflation we would expect to see may be muted somewhat. Global trade is interconnected and extremely complicated. For example, it's often the case that we export products to other countries which are assembled and refined there, then exported back to the US. Companies can also and have shown the ability to divert the country of origin to countries that are not affected by tariffs, like Vietnam. Another big offset is that foreign exchange can make up for the increase in prices. If the $1 decreases by 25%, for example, it would fully offset the additional cost of the importers in the near term. Now, longer term, Chinese exporters would likely raise prices to offset the weak yuan. Producer margins can also take a hit in the near and medium term as they cannot pass through higher costs. Less profits mean less spending. Slide 16, longer term, doesn't look too good to us. Despite some of these offsets, they only happen in the near and the medium term. Costs will likely increase. Rerouting supply chains is costly. Higher costs lead to higher inflation, which will likely lead to higher interest rates. Slowdown in spending coupled with higher inflation and higher interest rates will likely cause a recession and or stagflation, which would be bad for the stock market. Furthermore, countries, as is currently being done, are likely to exclude the US from trade deals. Slide 17. To summarize, near term, a business slowdown represents the largest threat as inflation is likely to be held down in the near to medium term. However, we think the market rally this year has likely overrepresented this fact, with a few exceptions in autos and energy. Should China wait to make a deal until after the election, it could result in a shock that would erase this year's gains. Sectors most likely affected would depend on what happens with interest rates. Consumer discretionary stocks, given a flat rate environment that have rallied much this year, like to us, represent some of the higher risks, with the exception of autos, which have already anticipated some of the worst case scenarios. We do think, however, if a deal is worked out, especially if one includes the opening of the Chinese economy, then global growth can not only resume but accelerate, with the US being a large beneficiary due to lower taxes, regulation, and access to fast-growing and more profitable Chinese economy.
So how are we positioned? Slide 19. If you look quickly at this chart, you could say that we are unafraid, given the overweight in industrials and discretionary with the balance tilted on technology. We are a bottom-up firm and have been picking spots, like autos, in consumer discretionary, where the valuations already reflect significant pessimism. Both the portfolio and the Dow Jones benchmark are both quite concentrated, so these big sector differences are often explained by only a handful of securities. On slide 20, some of our companies are trying to send signals that things will be okay in choosing to raise their dividends in this period of uncertainty. Even with short-term drops in profitability, boards have been willing to increase payout to display confidence in the business long-term.
So to summarize, we think that both China and the Trump administration have an incentive not to let this drag on further, but we also think the market has priced this in for the most part. Now, our strategy, as Evan mentioned, is to choose our spots carefully, purchase stocks after they have already declined when their dividend yields tend to be the highest, and the fact that the Halal guidelines screen out the most highly indebted companies, we tend to hold companies in good financial health, which also tend to protect better on the downside.
All right, thank you, gentlemen. That's going to bring us to the question and answer portion of today's presentation. If you have a question, go ahead and open up that dialog box on the GoToWebinar control panel and send it our way using that function, and we'll direct those questions to our experts. We'll go ahead and get started with one. As our listeners know, SKBA manages the Azzad Large Cap Value portfolio, and gentlemen, you even referred to sort of the effect on value stocks over the last several months, specifically as it comes from interest rates. We know that growth has outperformed value, and really, I guess, at least since the beginning of the year, if you look. And so we're trying to figure out, I think in this question, is value underperforming as a category vis-a-vis growth? Is it because of interest rates favoring growth stocks? Are there other factors here? How would you suss that out for the viewers?
Yeah, thank you for the question. Yeah, we definitely think interest rates are a factor. There are a lot of factors that go into it. Generally speaking, as I mentioned, when interest rates are low, that's the amount that you discount your cash flows back to present's low. You can afford to wait for more cash flows in the future if you're not giving up too much in terms of what you could be investing in right now. Interest rates go up, right? Then your opportunity costs increase, and you kind of want those cash flows more upfront. And those cash flows more upfront come with value stocks. We're paying a lot less money for current cash flows than growth stocks. That's one differentiator. But as I said, that's one factor. In indexes and indexation of the financial markets is also another factor in our opinion. The highest market cap companies that represent the indexes get all the flows, and those companies get larger and larger, and advances get more and more narrow. Technology stocks have become a much higher proportion of the growth indexes. To us, that's also dangerous, and so we try to, as I mentioned, pick our spots carefully. And we do think, however, if there is a catalyst that would perhaps shock investors into preferring their cash flows more upfront, then we do think if interest rates did increase, that could be a catalyst for a difference in preference from growth to value.
Which is interesting because it looks like the market is pricing in a rate cut to come later this month. So we'll see how that shakes out, I suppose.
Right. The inverted yield curve is definitely something that's contributing to the volatility here. But in reality, these things are cyclical. Stocks go in and out of favor, styles go in and out of favor, value has been out of favor for a while. We obviously, as biased value managers, don't think it'll last.
Very good. So we touched on monetary policy just now. Let's talk a little bit about fiscal policy. The question here is whether or not the tax cuts are completely offset by the trade wars. You mentioned the fact that during the Smoot-Hawley era, there were other errors besides tariffs, and that included almost confiscatory taxes. And one of the major differences now is that taxes are lower. So is it the case that tax cuts are offset by the trade wars? How would you describe that?
So the very simple answer, and you can see this in prices and earnings, is yes, but we did just spend a fair amount of time digging into what are the pockets of sectors and companies that were hurt. And so to really give a better sense of why that is, we also need to dig into who did the tax cut help and hurt. And the short answer to that is it helped everyone. But one thing that is very underplayed, especially in the media, is that when you look at the S&P 500 and the composition of earnings, the biggest beneficiaries of the tax cut were in tech and financials. Now, we did not really talk about these sectors as being hurt as severely on tariffs. So when you look at, again, an index like the S&P, you'll see that a large chunk of the earnings is going to go up and largely be unaffected because of the fiscal policy stimulus. Again, the rising tide lifted all boats. It happens that some of these boats were much larger, and they're going to be continue to be in an advantaged position. Now, when you look more specifically at sectors that were hurt and have been hurt by tariffs, they received benefit. But I think this is where you see, again, certain companies and industrials, the earnings are starting to come down. So you can say that from an earnings perspective, there is an offset. For companies that have not experienced that, you can see some multiple compression as well. So again, there you can also see some pessimism offset. But so to sort of wrap it up, broadly, yes, we've seen offset. We see the most offset in industrials. And the sort of theme that we want to talk about is in the tech sector, especially. Again, some of the largest companies got the biggest tax cuts, and they are additionally not impacted by trade pessimism, or have not been year to date.
All right, thank you, Evan. I have another question here regarding the sector positioning of the Azzad large cap value portfolio, considering the fact that SKBA agrees to abide by the Azzad screening methodology. And I know we had a slide about that. Could you speak to sort of how this helps and hurts in light of current trade regime as well as interest rate policy and prospects going forward?
Yeah, sure. So just from a sector positioning, it helps, hurts there. It's a different type of positioning in compared to the benchmarks, that's for sure. So we can't own companies that are highly in debt, right? So that, generally speaking, eliminates a lot of companies in materials and utilities, financials, obviously, which is a big chunk of the regular benchmarks weights. And instead, well, if you just think back to what I said about utilities being one of the better performing sectors and the strategy not having any exposure to it, just from that perspective alone, that can hurt. However, the flip side of that is that not having financials, utilities and financials tend to move in opposite directions. They can move both over long periods of time. One's asset sensitive and one's interest sensitive, meaning interest rates go up, utilities go down, interest go down, financials go up, and vice versa. We have chosen our sector positioning where to overweight as a result of not being allowed to invest in some sectors. Healthcare, you can see, is a bigger weight for us. We think that healthcare has better defensive fundamental characteristics than utilities. If you think about the demand for medical equipment, medical procedures, it ends up being more staple-like in demand. Here in the US, as the population ages, there's an even increasing demand for that. Now we also have to balance that against some of the pharmaceutical companies. As we're sort of marching towards an election year, they have become out of favor. We do have a good balance, in our opinion, of the companies that have very good pipelines balanced with those medical equipment manufacturers that will be less likely to be affected if new health law came into effect come after the election, for example.
And I would just reiterate that, you look at the slide, everyone looks pretty different. We look different from the Russell. We look different from the Dow Jones. Dow Jones looks different from the Russell. I would just note that both us and the Dow Jones are concentrated, relatively concentrated versus the value, and that our process is bottom up, and we do not necessarily target these sort of top-down sector weights. Again, we're primarily focused on buying companies out of favor. And so this is not the sort of end goal necessarily to end up as, positioned a certain way or not. We are more focused on, again, long-term value, downside protection. And yeah, so sector weights can fall, differently depending on the regime.
And just one more thing to add there to what Evan was saying. Basically, if there are a lot of opportunities in a sector, meaning a sector's out of favor, we think the dividend yields are much higher than average, and we think those dividend yields are sustainable, meaning the good companies and good financial health, then we'll tend to own more of them, simply speaking.
That's a good place to end it, I think, gentlemen. So with that, we'll go ahead and conclude the Q&A portion of the presentation as well as the presentation itself. Thank you, everyone, for attending. I'd also like to thank Evan Key and Matthew Segura for being with us today from SKBA. Just a reminder to visit our website, azzadfunds.com, where you can read more about the Azzad Large Cap Value Portfolio, along with all of our other strategies. Also, a shameless plug, there will be another webinar on August 8th at 2 p.m., which is specifically related to the Tax Cuts and Jobs Act, which was alluded to here today. Finally, be sure to follow us on Twitter. The handle is @AzzadFunds, and like our Facebook page, facebook.com/AzzadFunds. Thank you again for your time, and have a great afternoon, everybody.